Silver has always been the other precious metal, overshadowed by gold, yet historically capable of far more dramatic moves. As of December 2025, silver is trading around $63 per ounce, having risen almost 200% since early 2024. Analysts are increasingly calling for a major breakout, with some forecasts stretching toward $200 or more per ounce. To understand why, we need to look at the forces driving silver today: the historic gold-to-silver ratio, and the unique setup that makes silver not only explosive, but one of the most compelling investment opportunities of our time. Silver is both a precious metal and an industrial commodity. That dual role makes it more volatile than gold. As a safe haven, silver benefits when investors fear inflation or currency debasement. As an industrial input, silver demand surges with growth in renewable energy, electronics, and medicine. This combination means silver often lags gold during calm periods, but outperforms dramatically during bull runs. Several forces are converging right now. Currency debasement fears are rising with U.S. deficits ballooning and debt issuance at record highs, so investors are hedging against long-term dollar weakness. Institutional portfolios are shifting, with precious metals exposure rising after years of underweight positions. Silver supply has struggled to keep up with demand, especially from solar panels and electric vehicle batteries. Together, these factors have already pushed silver above $60. But many analysts argue this is just the beginning. The gold-to-silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, extreme highs have occurred, such as in March 2020, when the ratio spiked to over 120, reflecting silver's deep undervaluation. During silver bull markets, the ratio has collapsed to 16 to 20, notably in 1980 and 2011. As of late 2025, gold trades around $4,200 per ounce and silver around $63. That's a ratio of roughly 67 to 1. If silver were to return to historic lows of 20 to 1 with gold at $4,200, silver would need to trade near $210 per ounce. Even a move to 40 to 1 would imply silver over $100 per ounce. These levels align with analyst forecasts calling for $200 or more in silver in the coming months to years. Recent reports highlight this expectation. Analysts note that silver's volatility means it rises faster than gold in bull markets, with projections of triple-digit prices. Institutional portfolios are undergoing their largest reallocation in decades, with silver positioned to benefit. Inflation and safe haven demand are expected to drive silver higher. The consensus is clear. Silver is set for a large price surge, with $200 scenarios increasingly plausible. Silver's setup today mirrors past bull runs. It remains undervalued compared to gold, with the ratio at 70 far above historic lows. Supply constraints are intensifying as industrial demand rises faster than mining output. The fiscal backdrop of U.S. deficits and global debt issuance is fueling inflation fears. Investor psychology plays a role too, because once silver starts moving, momentum traders pile in, amplifying gains. This is why silver is often called gold on steroids. When it moves fast. In past bull markets, silver has shown just how quickly it can move once momentum builds. In 1979 and 1980, silver surged from under $6 to nearly $50 in less than 2 years, collapsing the gold-to-silver ratio to around 16 to 1. Again, in 2011, silver ran from under $10 to almost $50, with the ratio falling to about 30 to 1. Each time, the move was explosive, driven by a combination of investor panic, industrial demand, and speculative flows. These historic surges are the reason analysts today point to the possibility of silver reaching $200 or more if the ratio returns to those levels. Silver's supply side remains under heavy strain. Global mine output has barely grown, rising less than 1% in 2024 to around 820 million ounces, and 2025 is tracking similarly flat. Because most silver is produced as a byproduct of copper, lead, and zinc, supply cannot be scaled quickly even when prices rise. Meanwhile, industrial demand continues to accelerate. Silver is indispensable in solar panels, electric vehicles, medical devices, and electronics. The energy transition alone is projected to consume hundreds of millions of ounces annually. This mismatch has created a structural deficit for 5 consecutive years, with cumulative shortfalls now approaching 800 million ounces. Vault inventories have been steadily drained to fill the gap, leaving visible stocks at historically low levels and tightening the market further. Analysts argue that this persistent imbalance, combined with monetary and fiscal pressures, sets the stage for a dramatic revaluation. With gold trading above $4,000 per ounce, even a modest compression of the gold-to-silver ratio could send silver well into triple digits. If the ratio were to revisit 20-1, a level seen during past inflationary cycles, silver would be priced around $200. That's why forecasts of $200 or more aren't just hype. They're grounded in math, history, and the reality of a market running on depleted inventories and unsustainable deficits. Investor psychology plays a huge role in silver's volatility. Once silver begins to rally, momentum traders, hedge funds, and retail investors often pile in. The relatively small size of the silver market compared to gold means that inflows can have outsized effects. This is why silver rallies tend to overshoot, creating parabolic moves before correcting. Analysts expect that if silver breaks decisively above $100, the rush of speculative money could drive it toward $200 faster than most anticipate. Of course, there are risks. Silver is notoriously volatile, and sharp corrections are common. Investors who chase parabolic moves without discipline can suffer heavy losses. Supply deficits may ease if new mining projects come online or if industrial demand slows during a recession. Central banks could also intervene to stabilize markets if precious metals prices threaten financial stability. These caveats are important, but they don't erase the structural setup pointing to higher silver prices. The broader macro backdrop reinforces the bullish case. U.S. deficits remain large, debt issuance is at record highs, and inflation pressures are sticky. Bond yields have risen, but they have not eliminated investor fears of currency debasement. In this environment, precious metals are attractive hedges. Gold has already surged, but silver remains undervalued relative to gold. That undervaluation is the opportunity which is presenting right now. Looking ahead, the expectation of a large price surge in silver is not fringe. Mainstream analysts, institutional reports, and market veterans are all pointing to the same conclusion. Silver is poised for a historic move. Whether it reaches $100, $200, or beyond depends on how far the gold-to-silver ratio compresses and how intense investor demand becomes. But the direction of travel is clear. Silver has always been the metal of extremes. It lags when markets are calm, but when fear and demand collide, it explodes higher. With deficits rising, inflation sticky, industrial demand accelerating, and gold already at historic highs, silver's moment is arriving. If history repeats, the next few months to years could see silver prices not just double, but quadruple, rewriting the narrative of precious metals and delivering one of the most dramatic bull markets of our time.